I'm Charlotte McLeod with the Investing News Network, and you're about to watch my interview with Ian Ball, President and CEO of Abitibi Royalties, and Rob Phillips, Managing Director, Nasdaq Global Corporate Client Group. In the discussion, Ian shares his thoughts on where the gold market is at, and Rob gives his perspective as an exchange representative. We hope you enjoy. Let's jump into our questions. The first thing that I want to do is give the audience a little bit of context on why the two of you are here together today. So, Ian, I hoped you could start off by explaining Abitibi Royalties' relationship with the Nasdaq, what the listing there offers to you as a company.
Sure. When Abitibi was started, we were on the TSX Venture, and so we were looking for ways to access the U.S. market. But being a relatively small company, there's a huge burden typically associated with listing, outside of Canada. And so we had conversations with Nasdaq, and in particular Rob, who's with us here today, about the Nasdaq International program that allows you to have the sponsorship of the Nasdaq while you are an OTC listed company in the United States. But it does show that there's a bit of a branding exercise and a credibility factor being associated with the NASDAQ when you're in the United States. And it allows us to access the investor market, but without the additional burden of a full listing.
Perfect. And from Rob, I wondered if you could give me just a brief breakdown of the landscape of companies that are listed on the NASDAQ. In particular, if you could explain how mining companies fit in there.
Yeah, of course. And actually, I'll pick up where Ian left off too. So Abitibi is one of our NASDAQ international designation members. So this was a solution that we implemented a number of years ago for companies exactly like Ian had said, who are traded over the counter in the U.S., are headquartered and listed on their domestic exchanges, but didn't want to go through the regulatory burden of a U.S. listing. So this is a solution that we put in place where companies can avail themselves of the branding exercise that you mentioned and the access. So I can start with the global part of NASDAQ. We are known for listing companies. In fact, NASDAQ has evolved over the last 25 years into a publicly traded ourselves international financial technology solution provider. And at the very core of what we do is the listing exchange. So right now we list approximately 3,000 global companies that are listed in the US and on the NASDAQ exchange, and we consider them to be the innovators of the world. And they are also, from our standpoint, sector agnostic. So whereas we're known for listing the largest of the technology companies in the globe, in fact, in the NASDAQ 100 includes what we would consider to be the traditional sectors. If you're an innovator, this is the exchange where you belong. And we're thrilled with our partnership with Abitibi and consider, again, the international designation to be an opportunity for us to start the right kind of conversation to support our companies at their right point in their life cycle.
Perfect. Thank you so much for that. Ian, I'm going to go back over to you and ask you a little bit about what's going on with gold right now. When we spoke earlier this year, we were kind of having a discussion around what is the fair price for gold?
Right.
You mentioned a range of $1,750 per ounce on the low side, $2,450 on the high side. Gold is within that range right now. And I wondered what you think of that. Do you have an updated range you're looking at? Do you still feel that's a good place for it to be?
Well, I think that the range generally is still quite applicable. On the downside, that $1,700 number seems to be, fairly solid. Gold had a hard time getting above that 1740, 1750. It had consolidated there for a number of months back in the spring. So I still think that's sort of the downside window. When you look at the upper end of the spectrum, you could probably move that up a little bit, from the 2,400 perhaps up to 25, 2,600. And the reason why I would say that is there always seems to be a strong correlation between the gold price and the U.S. debt. And when gold has been in a bull market, if the U.S. debt was, if you go back to 2000 and 2012, the U.S. debt was 15 trillion and the gold price traded at 1,500. And that correlation stayed together for about 10 years. during the last run up. And so if you were to apply that today, the US debt right now is 26.5 trillion, moving up to 27 trillion. So that's why I think we can move that upper band just a little bit, just because of the deflationary, not, I wouldn't say deflationary, the dilution or the devaluation of currencies that we're seeing around the world, and hard assets are obviously appreciating. So gold is definitely one of those, and but I still think we're generally in that broader range that we spoke about from earlier this year.
Right. And I do remember that US debt was a factor that you'd mentioned. Are there other elements that you're looking at when you look at where the gold price may go from here?
Yeah, definitely. So if you look at historically, when gold has done well is when the U.S. government runs increasingly large annual deficits. And what number do you want to use right now? The official number is right now 2.8 trillion annual deficit for this year. Under the old method of accounting for the deficit, it's now over 4 trillion. It's been changed now, I believe, because of the accounting parameters that the U.S. government uses. But each year that deficit goes higher, or years of very high deficit, the gold price does well. If you look at some of the years under the Obama administration, they were able to reel back the deficit after 2012, and gold did quite poorly for a stretch there of about 8 years. But right now, it shows really no signs that annual deficit is going to be reduced in the near term. So I think gold has a window here that it will continue to be quite strong.
Okay, and Rob, I want to go back to you for the next question. With gold on the rise, what are you seeing from your perspective at the Nasdaq? I know you work with a lot of companies. Is there an increase in interest from gold companies in listing with you, or any other dynamics that you're noticing right now?
Sure. I can start with the capital markets, Charlotte, because it very much in our DNA is we provide robust and liquid capital markets to transact financial instruments. So in Nasdaq's trading side of the business, what we support is we own 30 exchanges globally that trade any one of a number of financial instruments. What we're seeing are liquid and robust markets. And it's our job to be, if you will, neutral connectors between buyers and sellers, and to do it in an efficient way, and to enhance and facilitate the price discovery. So we're encouraged by what we're seeing in terms of participation across the breadth of the capital markets. Yeah, in terms of the resource companies, again, we are completely agnostic about the business that the companies are in. If these are companies in good standing that have great businesses, then we want to have a conversation about where we can support them regardless of their life cycle. And then, Charlotte, one other thing I thought I'd add too is, given your Canadian audience as well, Canada is a very significant focus for us at Nasdaq. People don't realize, but we actually own an exchange in Canada that trades about 20% of the equity volume of TSX listed companies up there. No listing business, but it's a great one for us. And I've had the privilege of hosting your Governor General, provincial premiers, the ambassadors, and I work very closely with the New York Consul General to support all of the Canadian businesses and Canadian initiatives.
That's great. And you mentioned connecting companies and investors.
Yep.
Would you say that interest in what's going on in gold or in the mining space in general is being reflected in investors right now? We hear a lot about generalist investors coming into this space. So maybe you can comment on that.
What we do see again in our neutral position is participation across the spectrum of investors. So we're seeing encouraging signs of institutional as well as individual investors, and they're delivering, if you will, the volume into the markets that we're happy to support.
Okay, that's great.
Mm-hmm.
Ian, I know this is an exciting time for gold, but gold mining companies have definitely faced challenges this year due to COVID-19. As we start to see Q2 results come out, what's your sense of how gold companies are weathering the storm? And I know you yourself at Abitibi earlier in the year, you said it's really been fine for you. So maybe you could shed some light on that too.
Well, right, and I think what you're seeing is the industry has done, has coped quite well with COVID, and I think that's one of the reasons for that is just due to the safety protocols that mining companies already have in place. That they're used to having procedures to ensure that the employees are safe. So adding another layer in there for COVID isn't necessarily a new concept for mining companies. And I think their ability to ramp down, make sure their employees were safe, and ramp back up just kind of shows you the industry is very proficient in employee safety. In terms of how they're going to weather this, or what we're looking at in the quarterly earnings, if you look at the gold industry today versus 2012, the price of gold is roughly the same at $19.20 an ounce. But the biggest factors we have going for us today is the oil price is about half or a third of what it was in 2012. Oil at 150 versus oil at $40 to $50 a barrel. And obviously oil and energy is a big cost component of these miners. But the second thing I'd also would look at is the currency. The last time that gold reached $1,900 US, the Canadian US dollar were trading at par. So it means the Canadian gold price was also 1,900, where today it's at 25, 26, up to $2,700 an ounce. So to be a Canadian miner and have the currency where it is relative to the US allows you to control costs a lot better than 2012. All this relates into greater margin expansion today than what we had 8 years ago, despite the price of gold being exactly the same. So I think people have obviously learned from the past mistakes, and we're having things besides our control, as I mentioned, oil, energy prices, and currency that are acting as a tailwind for the industry.
Okay, thank you for that. Rob, as we are finishing up here, I want to ask if you have any final thoughts that you would want to share with the audience, be it investors or companies, about what you see in the environment right now.
Thank you, Cheryl. It's a great question because I was going to follow up on what Ian is saying, and just to emphasize, it's a great story that he's telling. And there's a lot of compelling stories to be told out there, and that's something that we're observing across the entire spectrum of market capitalization and of companies' businesses. And we're thrilled with the opportunity like this to support companies as they're getting out there and engaging with investors to tell those stories.
Well, that's great. And Ian, were there any final words that you would want to share?
Sure, and I don't know if Berkshire Hathaway bought their Barrick shares through an affiliate of the Nasdaq, but I think it's really important to point out that you have one of the most respected investors of all time making their first forte into the gold mining sector, and I thought it was quite encouraging that Berkshire didn't buy gold or a gold ETF or an index of gold mining companies, but they're making a very specific bet on one of the world's top two largest gold miners. There's still some debate who made that decision inside of Berkshire, whether it was Warren Buffett or one of his deputies. But I would say that it's a very large endorsement for gold going forward, and for the miners, and having the discipline to allocate capital in this environment. So I think that shouldn't be lost on the investment community.
Okay, well, I think that's a good place to finish up. Thank you both for being here today to talk about gold in the markets. It was great to have you.
Thank you for your time today.
Great. So once again, I'm Charlotte McLeod with the Investing News Network, and this is Ian Ball and Rob Phillips.